Greetings and welcome to our Apprise and webinar about understanding credit reports and scores. We are a nonprofit organization that is designed to help folks with their credit, their financial education, planning your money, planning your budget, and we feel strongly about all of these topics. So we have designed a several-part webinar to help. And of course, this is all about understanding your credit report and your credit score, why it's important, and what you can do to improve your credit. Apprise, again, as a nonprofit, is located in 10 different states, and I personally am Libby Ludwig. I am here to present today. I am located in the lovely Lexington, Kentucky office, and I'm here to answer as many questions and as many mysteries and myths as possible about credit reports and scores. Today, here's a list of several of the topics that we'll discuss. Of course, the reports and scores themselves. What are they? How are they developed? What do they mean? How to understand the reports, from getting your report for free once a year to how to read them, what information is and is not on the credit report, what to do about it, whether the information is correct, how long it's going to be on there, and of course the all-important question that everybody asks, what can I do to improve my credit score? We'll go through that in some pretty good depth throughout the next hour or so. And then touching on some other things that are up and coming. What are the new trends for credit reporting? Some new things that are in the works to hopefully help people have more full credit, as in to be able to understand their credit a little bit more. People who don't traditionally have credit or credit scores, how can they still be tracked and have whether they're a good credit risk or not? So we'll go through some of those as well. So let's start with some of the basics. What is your credit report? Basically, your credit report is kind of like a credit history. It's what you've done in the past. Who have you owed? How have you been doing on making payments? Some people like to call it their report card. How have you handled debt in the past? Have you paid things out well? Have you been behind on some things? It gives a full background, a full history of how you've done things. And it's important for several different things. Obviously, a lot of times when you're going to try to go get a loan, try to go get a mortgage, some of those kinds of things, it gives some background about you. Gone are the days from a couple of generations ago when you try to go get a loan from your bank and the person, the manager at the bank knows you personally and knows your family and knows whether or not you've paid things back in the past. Today, when you're going to go get your car from Honda, or you're trying to get your open a checking account, or you're trying to go get a loan to start a business for yourself, odds are good those people aren't going to know you personally. And so how can they get a sense of your financial background? And they're going to do it through the credit report. So it's important to know what's there, important to try to build your credit and credit report as best you can, because it's a lot of your story about you financially. It's your financial story. There are 3 credit reports, 3 credit bureaus, Experian, TransUnion, and Equifax, and they indeed work. They're for-profit companies. So they're buying and selling basically information about you. That's their full-time job. And they don't always have exactly the same information. Everybody always asks me that one. Why is something different on Experian than Equifax? Why is my score a little different? Why does some stuff show up on one and not the other? It's because they're competitors. They have checks and balances against each other. Sometimes you'll have a car loan through, ABC Bank that gives that information to Experian and not to Equifax, or vice versa. So not all of them will have exactly the same information, but they're usually somewhat similar because they, again, are trying to be in competition to each other and have the fullest information, have the best info to be able to give to, say, the car loan agency. When you're ready to go get a car loan, they want to be the one that gets pulled, that gets the information to the lenders. So when you're ready to start looking at your credit, why should you check it? Why is that important? Certainly, like I said, because lenders, when you're looking to get a loan, a car loan, a business loan, a credit card, a house, whatever, They're going to use that to determine whether or not you're a good risk. Are you somebody who is most likely to pay back the loan, and therefore they're not going to have to charge you too much because they know they're going to get all 30 years worth of mortgage payments probably from you? Are you somebody who's had a lot of difficulty in the past? Should that landlord maybe charge you a little extra by way of security deposit because they're afraid you're not going to pay everything there? So again, keeping track of it, having a good credit score can lead to a lot of benefits. And of course, it's got a bit of a story there about what all low credit scores can do. Obviously, just flat out being denied for accounts. No, we can't offer you this loan because of your credit. A lot of other things are looking at it now. Job searches, with unemployment continuing to fluctuate up and down. A lot of places, especially places that you'll have to handle money, are looking at how you've handled your money before they want to let you handle their money. Insurance rates, people who have better credit scores tend to have better insurance rates for their vehicles and such. Higher deposits, some of that we talked about. And of course, credit reports, like anything else, can have errors. A recent public service interest group found that almost 80% of credit reports have errors, whether that is having somebody else's information, which is fairly common, especially like for juniors and seniors within the same family, or somebody with a common name. You could have other people's information pulled into your credit report. Your bank or somebody could have reported information incorrectly. They could say that you're behind, but you really haven't been. There's all kinds of things that could be on there and could be incorrect. So checking it, even if you think you have pretty good credit, why should it matter? I'm not really worried about building my credit. Still looking at your credit reports at least once a year or so, just to be able to make sure that everything in it is correct and that you're getting the benefits of the good credit and good payments that you've had. Free credit reports. You can, thanks to a government bill that was passed not too many years ago, get a free copy from each of those 3 credit bureaus once a year. The only place to truly get it for free is annualcreditreport.com. And I always give a good little caveat here. There's a lot of places that call themselves free, but just because their name says they're free doesn't mean they are. Freecreditreport.com and some others that are kind of mimicking that website will tell you that they'll give you your reports for free. A lot of times they'll still ask you to put in a credit card or debit card number, and I always kind of am leery of those places. Why do I have to give a credit card number if it really is supposed to be free? It's because a lot of times what they're doing is either enrolling you in like a monitoring program or something like that, or charging you for the reports themselves sometimes, even though they say that the name is free. So again, annualcreditreport.com is really the one that you want. We'll talk a little bit more about credit monitoring and such a little bit later. By and large, that's really an unnecessary cost. If you can learn to do it yourself for free, I thoroughly understand the benefit of paying somebody to do services that is unsafe or difficult or something else like that for you, but by the time we're done with this, I think you'll see that it's a very easy process, and if you can save yourself some money, all the better. You really can do a lot of your own monitoring for free. A lot of people choose to do their credit reports where they get one every 4 months. So for example, they would get Experian in January, they would get TransUnion about mid-year, they would get Equifax in the fall. That way, about every 4 months or so, they're looking at least one report to see how it looks, see what's updated. Some people prefer to do it all at once, get all 3 of them, say around tax return time, double check it. If there's something that needs to be paid off or dealt with, they can do it then. It doesn't really matter one way or the other. It does have a little note at the bottom, wonderful loophole, I guess, caveat in the way they wrote the bill. Yes, you deserve to know that the information in your credit report is correct, so you get a free credit report. Technically, you don't need to know the score to know that the report itself is correct, so you don't get the score for free. They're not terribly expensive, about $8-ish per score. So if you're interested in the scores, you can pay for them through annualcreditreport.com. There's also a lot of estimators out there that can give you an idea of what your score is for free. One of the ones that we like is at myfico.com. That's myfico.com, and they have a FICO credit score estimator that's a good one. A lot of people also will use Credit Karma, Credit.com, some of those kinds of places. Nothing wrong with them. A lot of them are free. Some of them, they make their money by trying to sell you products, those kinds of things, but it's not required. Of course, don't fall for any of the gimmicks and those kinds of things, but realizing it probably isn't exactly what your score is, but it'll at least get you close. If your goal is to be able to, say, purchase a car in the next 6 to 12 months, you want to know whether your score is a 700 or a 500, and it'll get you at least decently close to that. So it gives you an idea. And all of these websites and extra stuff we'll have listed at the end as well, so you can copy them all down if you haven't had a chance to already. You are also entitled to a free credit report if you have had something negative that's happened directly related to your credit. You've been denied insurance, you've been turned down for a loan, on welfare, any of those kinds of things. So you would have to request the report within 60 days of that happening so that they know it's tied to that denial or whatever. You do have to make that request directly to the specific credit reporting agency. So for example, if you were turned down for a car loan because Equifax showed that you had a huge collection debt on an old apartment, then you could request your Equifax report to be able to review it, see what needs to either be paid and fixed, or if it's incorrect, to dispute it, have it taken off, etc. And we'll go through some of those steps of how to do that later on. But at least gives you an idea of some things that you can do to get an extra report, if need be, on top of that one regular annual report that you can get for yourself for free. And just briefly want to cover some of the new things that are emerging for credit reports and credit scores. There are a lot of Americans who, as we say, are outside the credit system. That means, for example, they don't have a car payment, they've always paid cash for a car or whatever, but they have been paying on things in the past but don't have a traditional credit score. But they're looking to start getting into credit. Personal example for this one, my husband's a great example. When we went to go purchase our house a couple of years ago, my husband had always driven his family's old hand-me-down car, so we never had to buy a car. He had heard all the horror stories of credit cards, so we never had a credit card in college, and didn't have any traditional credit payment history. He had literally no credit report, no credit score. So what he had to do was to go to his electric provider, his old rental place, the gas company, the water company, and get letters that showed the payment history, showed what he had been doing, showed that he was good for all of his payments and all that kind of stuff. But it was a lot of legwork and that kind of stuff for him to be able to co-sign with me for the house. What this is going to try to do is to try to track that information in a more standardized and simplified way, to be able to go through, I think it lists some of the info, including rental, especially rental information, but also utilities and some of those other kinds of things that traditionally haven't been reported on credit reports, so that they can track more stuff and therefore get more people into the credit scoring system. The rental data, and I've got a really neat quote for you from Experian, who has really been working hard at this. The quote from Experian says, "Rent is the single largest monthly expenditure for approximately 1/3 of the U.S. population, and until now it has been missing from credit bureau files. This has been an industry-wide obstacle that we have now solved. Experian purchased the Rent Bureau on June of 2010 and has now begun to use the influence of their credit scores and models with positive rental payments it is able to collect from this group." Which sounds great, because obviously if 1/3 of America is renting, somehow that should be able to be reflected in payment history. The problem, and I guess that's a strong word, but the problem is that it's still fairly new. Even being June of 2010, that's only about 3.5 years old, and a lot of the rental companies and agencies aren't yet participating. It's growing, but it's still by far defined under new trends. But again, it's something that's up and coming and hopefully will help a lot of folks as it moves along and as more and more rental agencies and utility agencies come to participate in that program. So let's talk about the credit reports themselves. What all is on a credit report and what isn't? Here's the basic information that is there. Obviously, identification. They have to know that it's you that you're pulling the report on. So that can include your social, where you live, where you've worked, some of that basic information. Obviously, your account information and payment history, who you owe, how much you owe, whether you've made good payments, etc. That can include collection accounts. So for example, if you had an old Verizon bill or something that had gotten closed out and not paid and not paid and not paid, they sold it off to a separate collection agency to try to collect that money. Collection accounts generally show up on credit reports. Public records could include bankruptcy. It could include unpaid tax liens. If you've gotten a judgment that's led to a garnishment, a lot of times those kinds of things will show up as public record. And then inquiries. Anytime you're trying to go and open a new account, that list of who you have requested a loan or a credit card from shows up as a potential inquiry on your report. Let's break each of those down just a little bit. For the consumer information, obviously it has your name, your social, your birth date, your addresses, your employers, and often it will have some old information as well, old places that you've lived, previous employers, and the reason that sometimes they'll have a lot of those or they'll sometimes have incorrect. Maybe somebody accidentally typed Jane Doe's birth date in as 4/15 of 56 instead of 65. All of those variations are because of the people who enter this system. So for example, if you came in and sat down with me, asked me to pull the reports so we could talk about them, however I enter your information into Experian, Equifax, whoever, continues to populate that system with more information. That's where they get those employers and those addresses and such from. It's as people pull the credit reports. And of course, like anybody else, sometimes we do typos and such. If there's something that's really, really off, for example, if you are John Doe Sr. and you pull it up and it also says John Doe Jr., some of those kinds of things may be flags to say, look extra carefully, you may have someone else's information also on your report, something that needs to be disputed or checked or fixed. So sometimes just going through the consumer information can help kind of begin to see if there might be issues coming up. But as a rule, a little minor typo here or there is not the end of the world. The biggest section by far of the credit report is the credit, the credit summary is usually the beginning. Not all of them will have this. It's kind of the opening information that gives you a summary about what all you owe, how many accounts you have, what they look like, just a quick snapshot of what all is going to be on your report. So assuming this is still Jane Doe's, revolving accounts usually means credit cards, something where the balance can go up and down as you use it and pay it off each month or pay it down. She has a total of 4 revolving accounts. The 4 accounts all together have a total balance of $5,678. For those 4 accounts, 3 of them are current, and one of them is at least 30 days behind. We don't know how behind. Maybe it's collections, maybe it's just a little bit behind. We can't really tell that from here, but one that at least has some negative information. Altogether, she has a total of 6 accounts, so the 4 revolving and 2 other ones. When we see that it has over $100,000 balance, odds are good one of those other 2 accounts is probably a mortgage. So maybe a mortgage and maybe a car payment, something like that. Again, 5 of them are current, that 1 revolving account that's delinquent. And then the account summary at the bottom. All 6 of those accounts are still open, no public records, nothing like that, nothing that's closed, and then a total of 4 inquiries. And remember, that is where she has requested some kind of credit in the past 4 years. Maybe it's to open the new Verizon account, maybe to open a new credit card account, whatever, inquiries from the past 2 years. This is the one that's the big information. The account history, you'll have one of these little blocks in whatever form it gives it for every account that you have. And minimally, it will go back 7 years. Negative information stays on the report for at least 7 years. Good information I have seen as old as 10 to 15 years. So you may have accounts on there that you haven't used in a decade, but it's still on your credit report. And people ask me all the time, is that legal? Should it be there? So long as it's good information, leave it there. That's good stuff. You want to build as much of a positive history as you can. Now, the things that are really, really old are not going to affect your credit score as much. We'll talk about the scores in just a few minutes, but everything that's a part of your history is still going to be there. I also have people who complain quite regularly. They say, you know, this was a collections account and it shows a zero balance, but, you know, I've paid that off. Should that still be on my credit report? Absolutely. Even though it's a zero balance, it's still part of your story. It's part of your history. It's part of what's happened to you. And the fact that it's paid off is good. I mean, that's not as bad as still having a balance on it. But the fact that you had something that went to collections, or you had a judgment, or you had whatever, is still part of the history. So again, it's going to stay on there for probably 7 years. So looking at the example we have in front of us, this one is, it says across the top in green, creditor name is XYZ Bank. It gives a portion of the account number. It's rare that you would get all 16 digits on an account number, but it'll at least give you a few so you can identify which one it is. Account type is revolving, so again, this is probably a credit card with that. Responsibility is individual. That means it's just in Jane's name. If it was joint between Jane and John, it would be a joint account or an authorized user or something like that. This one is just in her name. The minimum monthly payment, $55. How long the account's been open, so it's been open since '98. The last time they reported to the credit bureau, obviously this is a bit of an old account, or an old example, but May of 2012. As of May 2012, the total balance was $2,750. The credit limit was $5,000, so she could use up to $5,000 on this credit card with XYZ Bank. Throughout the life of the card, so from 1999 until 2012, the most she had ever had on her card was $3,500. The account is not past due now at all, and with a comment that even kind of clarifies that. It's current now, but it was 90 days past due. And we've got a little bit more information about that if you read the little codes across the bottom. It gives kind of a calendar of how things have been paid in the past, with the most recent being on the left-hand side and the oldest being over on the right-hand side. So if we start reading from the right-hand side, that would be October of 2010, it says okay, and November of 2010, okay. So you start reading along and everything's okay until June of 2011, and then it flips to 90 days past due. That's not uncommon. A lot of people say, how can it go from being completely up to date and looking fantastic to being 90 days past due all at once? Well, odds are good it wasn't. She probably got a little reminder from XYZ Bank back in April that said, you're a month behind, you need to get it caught up or we're going to start reporting to your credit bureau. And then in May they said, okay, we're really serious, Jane, you're now 60 days behind, you need to get it caught up or we're going to report to the credit bureaus. And for whatever reason, she either couldn't or wasn't able to or didn't know that it was behind, didn't pay it. Come June, she goes 90 days behind, and sure enough, XYZ decides to start reporting to the credit bureau, hey, you're 90 days behind, this is now affecting your credit score. She gets the memo, gets the idea, and says, okay, I've got to get this caught up. So she works in June, July, and August, begins to get it caught up a little bit at a time, and then come September of 2011, it's completely brought current again, and everything is okay. Happens to have another glitch in January of 12, but has had good payments since then. So that's the way that those work. And every credit report shows that information, or their codes are a little bit different, but the concept is the same. They show at least a year, 2 years of payment history, so you can follow along and see exactly when things fell behind. It gives you an idea of how that looks. For public records, like I said, this is usually for bankruptcies or liens or taxes or something like that, and it gives you all the details. In her case, a Chapter 7 bankruptcy, it has been finished and discharged. It gives the date that the bankruptcy was filed. The reference number would, in theory, probably actually be the case number, the year and the number of the case. We just have a generic fill-in reference number here, but for real ones, you'd have a real number there. The date that it was closed, or the date that it was, in this case, discharged, where it was filed, how much, etc. Not all of them are quite this full. This is a particularly good example of what all can be shown for public records. A list of inquiries. Like I said, inquiries only count for when you're actually trying to get credit. So for example, she was trying to maybe get a personal loan or something from Bank of USA, and then when she opened her mortgage back in 2011, both of those wound up getting listed on her report. If you personally, or a nonprofit or somebody, is pulling your credit report just for informational purposes, not to try to obtain credit, get a new loan, whatever, that is not listed as an inquiry. The technical term is a hard inquiry and a soft inquiry. Hard inquiries are the ones that actually are trying to get credit and show up on your report. The soft pull or soft inquiries are just for informational purposes. They do not affect your score, and they are not listed under the inquiries. Having too many inquiries, and again, we'll talk about scores in a minute, but just a short version, inquiries can affect your score if you have too many of them. Just because, for example, if you go out and try to open 6 credit cards next month, it's going to look like, for the next person who pulls it and sees those 6 inquiries, it's going to look like you have to have that credit to be able to manage your budget. They're going to be a little concerned that you have to have that credit to be able to survive, which makes you look like more of a risk. So too many inquiries brings your score down, makes it more difficult to get credit. They will often give some leeway for, let's say, for example, she had not just Orange Mortgage Company in October of 11, but she had 2 or 3 other ones, and then she opened a mortgage account in November. They're going to obviously see that as she's not trying to get 3 houses. She doesn't have to have that credit to live. She's shopping around for mortgages, and so they'll give a little bit more leeway for things like that. Again, as a rule, bottom line, too many inquiries can be a bad thing. Fair Credit Reporting Act, another great law that has been passed. If you find incorrect information on your report, whether that is information that's not yours, there's a medical bill on there that you say, I have never been to Good Samaritan Hospital, we always go to St. Joseph, this cannot be mine, or something from a crazy out-of-state whatever, or even what I see very regularly, somebody had a collection account, they've paid the collection account, but it's still showing with a balance on their report and it needs to be fixed. You can write a letter. It never hurts to contact the creditor first, to contact the collection agency or whatever, just to make sure it's been paid, make sure it's not yours. But if you can show that it's been paid, or if they don't have any documentation, whatever, you can always write to whichever credit bureau has it wrong, Experian, Equifax, TransUnion, and say, this is the account that needs to be checked up, here's what's wrong, fix it or remove it. And they're required to do that. There's no charge to the companies to do that. There's no charge to you. They have 30 days to investigate it. They have to report back to you and tell you what they found, what their plan is, what they did. Share the updated information and go from there. And once the report is updated, you are indeed entitled to a new report. We do recommend, it's not required, but we do recommend that you send a letter certified just so that you can prove they received it, prove the date, and those kinds of things, just in case it comes down to that. Most of the credit bureaus also now have an online way of doing this so that you can track it online as well. Some of them even prefer it. I've seen at least 2 of the 3 who will do it that way. If you go to their website, they have a whole section devoted to disputes, questions, complaints, those kinds of things, where you can try to get things updated. accurate negative information. So for example, like I said before, that collection agency, say you paid it, you disputed it, it now shows a zero balance, but you don't want it there because it's pulling down your score and it's been paid off. Why should it be on your report? Sadly, that still is accurate information. It's still a part of your history. If you look at the list here, most things are on your report for 7 years. Positive information can be on there longer than that. Bankruptcies can be longer than that. But by and large, it's still going to be part of your story. This is where a lot of scams, this is where a lot of people get into scam stuff. Companies will try to make false claims that they can remove information that's negative, or they can try to send in dispute letters to try to have information removed, even if they think or are pretty sure that it is correct. Again, there's no reason to pay somebody to do that for you if you really can dispute it. If it's accurate, it's really not worth disputing. It's just going to be there. However, the good news to that, and I tell this to every person who comes and sits with me and does a credit report review, what's in the past is in the past, and you can't change your past, but you can change the future, and you can start changing the future today. So starting to make a new payment history, vowing from this point forward, no more bankruptcy, no more late payments, no more, all of the negative stuff, getting things paid off and moving forward. And the good news, the other part of that good news is, what matters most for your credit score is what's going on now. So the older this bad information gets, the less important it is to your score. So even if you had a bankruptcy a year ago, and it's affecting your score, it's going to affect it less a year from now and even less 5 years from now. So again, it's still going to be there, but it's going to matter less and less, and your score can recover from negative information. It's not instant. You can't change 7 years worth of history in one night, but it can go back up. Speaking of credit scores, credit scores are basically a distillation of all that information. Your credit report may be 2 pages, it may be 22 pages, it may be 32 pages, but your credit score is a single 3-digit number. It takes all of that information into consideration and boils it down and runs it through an equation and spits out 3 digits, and that's your credit score. Almost all of them range from 300 to 850. And as with elementary school, high school, college, the higher the score, the better you did on the test. So you want to get it up into the 800 range if possible. We'll talk a little bit about what good scores are in a sec. FICO is by far the one that's most well-known and well-used, but there are other ones, and there's some new ones coming out. Vantage is one of the newer ones that's being established and that kind of stuff. But by and large, it's going to range from 300 to 850. What makes up the score? Well, and it should be on another slide as well, but I'll say now, the basics of the scoring. The average score, everybody says, what do I need to have? What do I need to aim for? I'm going to go get a house. I'm going to go get a car loan. What do I need to aim for? 650-ish is generally kind of the standard for minimum to be able to kind of get your foot in the door and get something. But of course, the better your score, the better the rate you're going to get. So I always tell folks, don't stop at the basement. Keep going. Keep working on credit scores. 660, 675, up to 725 is kind of the good range. That's where you're going to begin to get decent rates, decent everything. Above 725, 750 is where you're going to get the best scores and the best rates. Below 650, it doesn't mean you're not necessarily going to get a loan or something. I've seen some car loans and such for below 600, 575 even, but we'll see an example in a little bit. The rate's not going to be so great, and you're going to wind up paying for it in the long run. But again, we'll come to a couple of examples as we progress. So what makes up the score? What do you need to do? What do you need to worry about? Some of those kinds of things. This is a simple chart. We're going to go through each of the 5 things in just a sec. The payment history obviously is the biggest. How have you paid in the past? Amount of debt, length of credit history, new credit, how new is your credit, how much have you done recently, and then the types of credit. So let's look at the biggest one, payment history. The biggest single thing is have you paid stuff in the past? How have you done? Again, kind of looking back at that old adage of they don't know you personally, all they know is how you've paid everybody else. And again, it kind of looks at if somebody has been borrowing money from you regularly, would you be more interested in giving somebody a loan if they regularly pay you back, or if there's somebody who always stiffs you for the 50 cents to go to the Coke machine? Severity means how far behind has it been? You know, do you have a mortgage payment that's 1 month behind, or do you have a mortgage payment that's 5 months behind? Because if it's 5 months behind, it's going to affect your credit score more. How often have you been behind? What's the frequency? Are you somebody who, you know, had a blip here or there and just kind of, you know, didn't have a good month at work and so you missed a credit card payment, but you usually get it caught right back up the next month? Or are you somebody who just continually has something that's running 30 to 60 days behind? And then recency, and that's what I just said about the most recent transactions being the ones that affect you the most. In that example with somebody who's 5 months behind on their mortgage, somebody who was 5 months behind 2 years ago when they lost their job but have since made it up is probably going to have a better credit score than somebody who right now is sitting at 5 months behind. So how recently that's happened. Those are the things that go into payment history. The amount of debt that you owe, this one's a little bit of a complicated one, but not too much. Credit card debt is pretty obvious. Say you have a credit card with a $5,000 limit. How much of that $5,000 limit do you regularly use? Now, for the purposes of credit cards, it's going to show what your high balance was at any point in the month. So, for example, I regularly have folks who come in who have not a whole lot of credit. They're just building it up. They only have maybe a $1,000, $500 credit line. But they will max that out every week and pay it off every week to be able to get bonus points or air miles or whatever it is. But they look at their credit report and they say, well, I pay it in full every month. Why does my credit report still show that I'm maxing out my credit card? Well, it's because you're maxing out your credit card. Even though you're paying it off every month, it's required to show how much you've been using of it. And the goal is to keep the amount of debt that you have under a third of whatever your available credit is. So for example, that person with the $1,000 credit limit, you want to keep your monthly usage under $300. So if you're going to have to use it every week, you only use $300 and pay it off, and use $300 and pay it off, rather than maxing out the $1,000 and then paying it off. Keeping that total amount used. Installment debt is like your car or your student loan or whatever. There's no obviously easy way to pay it off every month. But as you go throughout the 5 years or 10 years or whatever of the repayment process, you'll gradually be paying down the debt. And so paying down the debt will help. And of course, by the end of 5 years worth of a car payment, hopefully you'll have 60 months worth of good payment history, which will also help. That's part of your 35% payment history in the past one. But as you pay things down, as a rule, the better it gets. This is the one place where, if you have the money to, you can make an immediate dent into increasing your credit score. Because if you, for example, have $10,000 worth of credit card debt and you've been living with, you know, $6,000 or so on those cards, you can take a $4,000 tax return, pay it down to $2,000, and instead of having 60% of your card being used, you now only have 20% of your card being used, which does help your credit. It's one of the few things you can do to, not quite instantly, but as close to instant as you get with credit reports and scores, increase a credit score. On the flip side of that, credit utilization, as in how much of the credit cards are you using. A lot of people ask about closing credit cards. I'm not specifically against closing credit cards. For some people, it's not a bad thing, especially if, for example, you're somebody who doesn't check your credit regularly, which hopefully you won't be by the time we're done with this. But there are those people out there who just say, I'm not good at remembering to check it. I'm afraid I'm going to be a victim of ID theft. You're at high risk for being ID theft. It's cards you don't ever use. You don't read the statements, or you don't get regular statements. For some of those kind of cards, it's worthwhile just to close them and be done with them. But here's something to think about as you do. For example, if you have, in this example on the screen, if you have a total of 5 cards with $25,000 and you have a balance of all the cards together of about $7,500, you're using about 30% of your available credit. Not too bad. It's probably not affecting your credit score because that's under that 30 to 35% kind of magic percentage. However, if you close one of those cards so that you have taken it down to a total of 4 cards and only $15,000, you still haven't paid anything. If you haven't paid anything down of that $7,500 balance, you're now using 50% of your available credit. So that could affect your credit score because now you're using more of your credit. So I always have folks that chuckle at this, but it really is true. The folks with the best credit, at least when it comes to amount of debt, is people who are available and have the credit available to use, but don't really need to. Don't have to every month, don't need to take out extra money all the time, and can work on getting it paid down. I had somebody in my office not terribly long ago that always kept his cards at exactly 30%. He thought that that was the wonderful magic number, and so he wanted to keep it always at 30%. 30% or less, and or less are the key 2 words there. 0 is fine. There is nothing wrong for your credit score for having a 0 balance and paying off your cards every month. If you don't use the cards ever, eventually the credit card companies may close them due to inactivity, which again would put you in the whether or not you want to have your credit cards closed or not. But if you just use them, say, for a tank of gas a month, or 1 or 2 trips to the grocery store, something like that, pay it completely in full every month. Number one, you're getting the same wonderful benefits to your credit utilization ratio, and you're also not being charged interest. And the real goal, I mean, the whole point of the presentation, the whole point of this information is to save you money in the long run, to save you money in interest, to save you, because of having good credit scores, saving you in fees, in interest, in insurance rates, and all that kind of stuff. So yeah, don't feel like you have to leave it at 30% or less. The other thing to think about if you do wind up closing a credit card is which one to close. That's actually the next one, length of credit history. The longer you've had a card, the more it affects your credit score, and the better it affects your credit score. So for example, in the last one that we saw where you had 5 cards going to 4, let's say you had 2 cards that both had a $10,000 limit. Let's say you had a City Financial that you had had open since 1990, and you had a Capital One with a $10,000 limit that you had just opened in 2011. And you don't really need both of them, and you're not really following them, and the credit utilization isn't an issue. Which one of the 2 should you close? Close the one that's newer. Keeping the long payment history is much better for your credit score because part of what makes up your score is the average age of accounts and the age of the newest account. So the longer you've had stuff, the better. Which also plays into new credit. How many inquiries have you had? How many new accounts have you had? So to some extent, opening a new account affects you in 2 ways. Number 1, you have to have the inquiry. Number 2, it shows up as your newest account. And number 3, it lowers the average age of your account. So it actually affects it in 3 different ways. So I always tell folks, if you're looking to build credit, don't go out and do something immediately before getting the big mortgage or getting the big car loan or whatever, because your score is going to drop in the short run because of all that activity, the new inquiry, the new account. If you're going to try to build credit, make whatever changes and then give it 6 to 12 months before you do something else to give it time to recover. Which leads to our last 10th, types of credit used. Revolving installment and mortgage. By and large, credit scores and people who pull credit reports say that the way you have to manage your money to have a credit card account versus a mortgage is slightly different. And someone who can manage both a mortgage and a car payment and a credit card well is a better risk, more likely to better manage a new account than somebody who just has, say, 5, 10, 18 credit cards. It's not huge. It doesn't make a humongous difference. It's the rare person that I say go out and open a credit card because it's going to help your credit. But by and large, this is another small factor in what makes up your credit. So again, for what it's worth. A little distribution about credit scores. More people have a 750 to 800 than anyone else. If you were to add them all together and average them out, the average person is probably somewhere between 650 and 700, which is again about where they would want you to get started for getting decent loans and such. But by and large, most folks have decent credit scores this day and age. The FICO score that indicates risk, I like this little one. It basically says, it gives you a visual example of why people who have poor credit scores get charged more. Because they've noticed that people who have been behind in the past, so for example, somebody that has under a 500 credit score that's been behind on things in the past has an 83% chance of doing it again. And we all, to some extent, know this to be true. I mean, going back to our dopey example of the people who always hit you up for 50 cents for the Coke machine at the end of the week. You know, you've got one person who regularly pays you back the next week, and then one person who's been bumming money off of you for 2 years and they've never paid you back. Which person are you going to be more likely to give 50 cents to next time they ask? Well, maybe you're a good person and you say, it's only 50 cents, it doesn't matter, I'm going to pay it forward and be a really nice person and give it both to them. What if it's something bigger? You know, what if it's, I need 20 bucks to put gas in my tank? Are you going to give 20 bucks to both people? You know, where do you draw the line between somebody who is likely to pay you back and somebody who isn't? And so again, it gives a visual example of what happens with people who have either done well with payments in the past or who have not. This is the one I was looking for. Your score really matters. 2 different car loans. Somebody who has, like I said, you don't have to have a 600-something credit score to qualify. There are car places out there who will give you a car loan with a less than 600 credit score. And yes, a 17% interest rate is fairly realistic. I've actually seen several up in the 20s as well. Versus somebody who has a pretty good credit score, 700 plus. And the interest rate for them is probably closer to 3-something. I've seen 3 and 4% interest rates as well. So if you look at that $10,000 car payment over a 3-year, and that's only a 3-year, most of them these days are even longer than that, which would just exaggerate the difference. Altogether, they're buying the same $10,000 car, but the person with less good credit is paying more than $2,000 extra in interest for the same car. No better car, no better or nothing. It's just in the interest over the 3 years. So the better your score, the better you manage things, the less it's going to cost you in the long run. Credit score disclosure notice. When do you get your credit score? When can you request a credit score? Certainly, obviously, if you get denied for something and they have to tell you why, if you didn't have a good enough score to get the loan, or if you didn't get the best rate. Say you're that person that got the 17% interest and you go, oh, that's terrible. Why did you give me 17% interest? Or why would you want to give me 17% interest even if you didn't actually take the loan? You can go through and get your report as well as your score so that you can know what's going on, see if there's something that was incorrect, something that needs to be disputed. So if you're going to go back and try again to get a vehicle, say you turn down that 17% interest because you think that's atrocious, you're going to work on your score for 6 to 12 months and go back again. You can get the report, get the score, see what to work on, try again. Credit score myths. Some of these we've actually already talked about. Credit counseling destroys a score, whether that is, and you could be looking at that 2 different ways. Of course, we've already talked about if you're coming just to get your credit report report pulled and see what's going on. That's not trying to get credit. So if you're not trying to open a credit line, it doesn't affect your score. Even repayment programs and those kinds of things don't necessarily affect your score nearly as strongly as a lot of people fear it does. Closing accounts, whether closing accounts always helps your score, not true. We've seen that it can affect your credit utilization ratio, which can hurt your score. Checking your FICO score can hurt your credit. Again, so long as you're the one pulling it and you're doing it for informational purposes and not to get credit. It's not a hard inquiry. It doesn't show up on your report. All credit reports are the same. Again, Experian, Equifax, and TransUnions are competitors to each other. They do not have all of the same information. They don't talk to each other. Divorce decree automatically severs joint accounts. We see this quite regularly. Anything that's a joint account is still a joint account. And again, we'll talk about co-signing and such in just a few minutes. With a co-signed account or a joint account, both parties are 100% responsible for the debt. So again, it's both people will still be responsible. You have to talk to your divorce attorney, see who's going to be responsible for what, see if they're going to refinance things, some of those kinds of things. So talk to your divorce attorney if that's your specific situation. I don't need to check my credit report. I pay my bills on time. I know I have good credit. I got a good credit score. You know, I just tried to get a loan last month and I got a 3% interest rate and everything should be fine. Still doesn't mean that you don't have stuff showing up on there that's incorrect. You never know if and when you might be a victim of ID theft, or if something, you know, again, banks and credit reporting companies are human. All this information goes through human hands. Things can get typed in and entered wrong. Never hurts to double check and make sure. Improving your credit score, and most of these things we've talked about already. Obviously paying bills on time, because 35% of what makes up your credit score is how you've paid debts in the past. Reducing your debt. And that can mean several different things. It can mean obviously paying down your credit utilization so that you have less, paying off collections, and this almost falls under the myth category. A lot of people think that paying off a collection will automatically and immediately raise your credit score. That's not true, at least not with FICO. What it does do is when you have a collection on your report, especially one with a balance, it puts a cap on your score. It can't go above a certain amount. No matter how fantastic the rest of your report looks. You've never been behind on your mortgage. You've never been behind on a car payment. You have a utilization of 10%. You're good to go, but you have a collection account. It's going to put a cap on your score. Paying that off so that it shows a zero balance will at the very least raise the cap, the ceiling on what your credit score can be, and once it falls off, or if the collection agency is nice enough to remove it, it will completely remove the ceiling from it. So I have a lot of people who say, you know, I don't want to have to worry about my collections. I'm just going to wait for them to fall off my score. It doesn't matter. It's only a $10 medical bill. It's not a big deal, especially if it's a $10 medical bill. Just pay it and be done with it so that it can take some of that ceiling off and be able to at least let your score begin to recuperate. Another thing that a lot of people ask about for reducing debt is doing settlements. This isn't the time and space to go through all the details of that. A settlement is a legal way of paying less than the full amount that you owe for a debt. So for example, if you owe St. Joe Hospital $10,000 for a huge bill that you had, and they say we're willing to take $6,000 instead and say that it's been satisfied, that's a legal option. There are a lot of negative ramifications to it, which again I'm going to let my very smart and capable coworkers handle in another presentation. But do realize that that does show up on your credit report that you settled for less than the full balance, and it's not as good for your credit score than paying in full, especially when it's little things like that, smaller ones as opposed to the $10,000 one. But again, paying in full, much better, and I'll try to not give too much other information and get on my soapbox about settlements for those kinds of things. Keeping the balances low, like I said, keeping that utilization down under at least that 30% mark. applying for and opening new lines of credit only when you need them. That way you're not getting a whole lot of inquiries that you don't need and lowering your average age of your accounts. And then, of course, checking your credit report for accuracy. Making your credit report work for you. Basically, this just means having a goal, understanding what your financial priorities are. Is it that you want to buy a house in the next year, 2 years, 5 years? Is it that you're a college student that's looking to move out on your own and you want to start building credit for the first time? Or maybe you're just getting out of college and you have lots of student loans and a whole lot of credit card bills that got run up and you have no idea where to start. Whatever it is, saying this is where I want to be. Financially, these are the things that are important to me, and this is where I want to be within the next 6 months, year, 2 years, whatever. Overall goal, at least from our perspective and what we try to help people with, is to keep the cost of credit low. The most important thing is being able to fulfill your goals, being able to get accepted for the job position that you want because you don't have any issues with your credit. Being able to get a car loan at that 2 or 3% interest so that you don't have to pay so much for interest in the long run. A lot of those things. And some of these simple steps can help reach that goal. For folks who are out there establishing credit or rebuilding credit, say you've had a bankruptcy, for example, and you have absolutely nothing on there, where can you go? Where can you start? We hear these questions all the time. And I want to hit just a little bit on 2 of these and then maybe a third one. A secured credit card. The little note at the bottom really is true. Check with your financial institution, somewhere that you already have an established relationship. Do you have a checking account or savings account with a local bank or a local credit union? It's a great place to start. For example, say you have a checking account with Chase Bank, whoever. And you almost always, you've never had any insufficient funds fees. You usually keep $300 to $500 or so in the account pretty regularly. So you go to somebody at Chase and you say, hey, I am thinking about trying to get into credit. What do you think about a secured credit card? And what a secured card does is it takes a portion of that money that you have, say $300, puts it into a separate account, and they give you a credit card with a limit of $300. So that if for whatever reason you can't or don't make the payments and you default on the card, they can take that $300 and pay off the credit card. So it secures the card with a separate account. They're usually not fantastic terms. You usually have an annual fee. You may have a moderate to high interest rate. But it's not designed to be a long-term credit card. You're not going to necessarily keep it more than 2 or 3 years. It's something to get your foot in the door until you can establish credit and then either transition that card into one with better terms with your bank or into a different account or something like that, different type of credit card. Another one that's up and coming, I'm a fan of these, is the secured loan with your bank, with a CD loan basically. And the way it works is, say you're going to go in and you're looking to establish credit. You're willing to do, say, a $1,000 loan, but rather than getting that $1,000 to pocket immediately, you walk out of the bank with $1,000, they take that $1,000 and put it into a CD, certificate of deposit, so that throughout the course of your year or 2 years of payments or whatever it is, they're funding a CD for you. Now, usually the interest rate on the CD is not quite as good as the loan that you take out, so I mean the bank is still going to make some money on it, but it gives you more money than what you would have otherwise. And it's good for the bank because they're making a little money and it's a secured line. They're securing it by the CD. So by the time you're done with your payments on the loan, a year, 2 years, whatever, not only do you get your $1,000, but you're getting $1,000 plus the interest that the CD has created. So you're getting a little bit more out of it, plus building credit. Brief word on cosigners. It is another way to get into establishing credit. So for example, if you don't have any credit or don't have good credit, but you have a spouse that does, a parent that does, a sibling that does, a friend that does, whatever, they can cosign for you and they can apply their good credit to the loan and help you get the loan. no problems with, well, I won't say no problems with that. It's a legal and viable and honest way of doing it. It does make both of you completely responsible for the loan. So for example, if you can't make the payments on the car, not only is your credit report getting hit with those negative information, so is your cosigner. Your spouse, it can pull your spouse's credit down or your friend or whoever's credit down as well. And I think the more important thing is if you're the person who's thinking of being the cosigner, perhaps you're listening to this webinar on behalf of a college student or somebody who's about to get established and embark in their building of their credit, and you're thinking of cosigning for them, my only recommendation is don't cosign unless you have the money to be able to foot the bill yourself if they can't. Say it's for a child and they're working a part-time job to help make the little car payment, but they lose their job. Can you take over that $150, $250, whatever a month car payment if they can't do it? Because if they can't pay it and you can't pay it, both of you wind up with bad credit. So again, just being cautious about being a cosigner, but it is an option. Opting out, once you start getting into the credit arena, getting into credit cards or anything else with public notice, filing bankruptcy, some of those kinds of things, you get on a mailing list where you get all kinds of fantastic pre-approved credit card offers, which you may or may not be completely approved for. There is a way to opt out of getting some of those spam mailings and pre-approved offers. We offer some of that information here. The do not call registry also works. Technically, they're not supposed to already be able to call cell numbers, or at least not with automated dialing systems, but it never hurts to use that as well. I can personally vouch for the opt-out. It really does work for the 5 years. I did it for the 5 years, and I know it does work. And it's helpful. It gets you out of a lot of that kind of stuff. And especially, well, if you don't own a shredder, you should get one. But if you don't have a shredder or don't always tear up all those pre-approved offers, that is an easy way for people to steal your identity, trying to open an account in your name. So unless you're going to be very thorough about making sure they all get shredded, unless you're looking to try to get credit and you want to check out some of the pre-approved offers, opting out, I'm a big fan. Here's a few of our other resources, some of the things we talked about at the beginning, the FICO and the FTC and the annualcreditreport.com, of course. We've also got our website up there, and there's several things on our website that I'd like to point out to you and offer. One is to just take a minute to subscribe to our Money Minute. It's a little newsletter that we send out every month through email. Just give some basic tips and tools and reminders, always things that are pertinent for that particular time of year. We've got a lot of things going on that's getting you ready for various planning and expenses that are happening this time of year. The other thing is we also talk about some of our services. If you have been through this presentation and this webinar and you're excited to get your credit report but you don't know where to start, you're not an online or a phone savvy person to try to get your reports and understand them yourselves, and you want more information, we'd be happy to help you with that. We offer a credit health education session. It's a chance to work one-on-one with myself or any of our counselors here to pull all three of the credit reports and talk through them, help you get started on disputes if necessary, help you set out a plan for how to get stuff paid off. If that requires some basic budget information to help find the extra funds to be able to do that, we can do that as well. The Credit Health Education session is one of our fee-based services. It's $45 for an individual, $60 for a couple. But we also always do have free services. If you've already gone to annualcreditreport.com, you've gotten your reports, but you need some help kind of looking at the budget, figuring out ways to trim here and there, and you want to talk about the pros and cons of settlements versus repayments versus paying in full, and just need a little bit fuller information, we can always schedule those types of appointments as well. We can do it in person, we can do it over the phone, email, through our website. We try to make it as simple and easy to use as possible. If you have other questions, of course, we have our phone number and our website. We tell you to check us out if you can on Facebook, Twitter, Google+, LinkedIn, or Pinterest. We've always got new information, new webinars coming up, and we'd be happy to help you. Whether it's through our online information or one-on-one, we're here to help. Thanks so much for listening, and have a wonderful